Gold will go up because currencies are going to be debased. That was only a couple of years ago. Now we're at 23, 2400. We're worried about 3% price moves, which are important. But again, it's impossible for me or anyone to time when gold hits 3,000 or 3,400 or 3,500, but it will be in my lifetime. So I'm not worried about the daily gold price. Whatever currency, be it a euro, a yen, or a yuan, or even a Swiss franc, and certainly a US dollar, they're just going to get weaker. And so I think when you even see Goldman Sachs or the commercial banks projecting 2,700 gold, then you know things are happening.
According to average inflation figures, the US dollar has lost 25% of its purchasing power over the last 4 years. Gold has risen approximately 50% since 2019 and has outperformed the purchasing power of the US dollar by more than twice. Gold versus the US dollar since 2019 is another example of gold holding your buying power, which your US dollar currency does not. Distinguished financial analyst Matthew Piepenburg, associated with Matterhorn Asset Management, offers a profound outlook on the enduring relevance of gold during current volatility. In his analysis, Matthew Piepenburg asserts his confidence in gold as a safeguard against currency devaluation. Concurrently, analyst foresees gold value increasing as currencies weaken, drawing on historical evidence since the gold standard was abandoned in 1971. Gold prices have risen over the past 4 years, despite the relatively stable dollar. Global central banks will also continue to increase their gold reserves to achieve de-dollarization. Regarding gold, Piepenburg firmly believes that despite its comparative lack of excitement next to stocks or Bitcoin, its unmatched ability to safeguard wealth underscores its indispensable status in any investment portfolio. Gold has risen about plus 30% since the fall of 2023 through spikes, some of which were difficult to connect with specific events or fundamentals. A combination of factors played out. Meanwhile, in his analogy, Piepenburg illustrates that the axe of currency devaluation gradually diminishes everyone's wealth, even if they're unaware. Now we present the clips of Matthew Piepenburg's insights from his recent interview with Silver Bullion TV. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Well, look, just not that long, gold was at 1,600, and I said, I'm not worried about the gold price in dollars. I'm worried about, I measure my wealth in grams and ounces, but I said, and I'm not saying this because I'm always right. I'm not always right. I don't know the answer to everything, but I know gold will go up because currencies are going to be debased. That was only a couple of years ago. Now we're at 23, 2400. We're worried about 3% price moves, which are important. But again, it's impossible for me or anyone to time when gold hits 3,000 or 3,400 or 3,500, but it will be in my lifetime. So I'm not worried about the daily gold price. Egon, my partners, my colleagues, we don't sit there every day checking because we're not trading, we're not swapping, we're not arbitraging. We're just sitting there simple, stupid. And our clients are sophisticated people, but it's simple, stupid. We just know that whatever currency, be it a euro, a yen, or a yuan, or even a Swiss franc, and certainly a US dollar, they're just going to get weaker. When you even see Goldman Sachs or the commercial banks projecting 2,700 gold, then you know things are happening. But in a lot of ways, silver is a different story. Of course, it's not for widows and orphans, as Egon would say. It will have its moves. I'm not here to predict when. I know that the dollar will get weaker. I know that the forces at the COMEX are getting weaker to stop it. And I know that gold will go much, much higher. And I really don't need to worry about, I say, it's like if you're a turkey in a farm in America, we have Thanksgiving every year. For your viewers who don't live in the US, we have Thanksgiving. Every year a turkey gets slaughtered for Thanksgiving dinner. And if you're a farmer feeding that turkey and the turkey thinks the farmer loves him and the turkey thinks everything's fine, the turkey doesn't need to know what day is Thanksgiving. But if that turkey knew that at some point the axe is coming, it's simple, but I don't need to know what day the axe comes. It's already cutting slowly at all of us right now. It's already what's happened to the dollar's inherent purchasing power is already evident. Since 1971, the dollar, all the major currencies have lost more than 98% of their purchasing power when measured against gold. And I was just this week in Singapore at a very sophisticated gathering of sophisticated investors doing private equity and venture capital and real estate and arbitrage plays and alternative investments. And they're talking about their rates of return. It's fascinating to me. And I come from that world in Wall Street. I'm not mocking it. There's all kinds of ways to get 8% annualized or 7 or maybe more. But you're still measuring that wealth in an ice cube that's melting, in a currency that's melting. And I showed a simple, you can show all kinds of graphs, but it's a simple example that anyone, whether you're a family office in Singapore, New York with hundreds of millions of dollars, or whether you're struggling to pay rent in Milwaukee, we can all understand a simple story. In the 1920s and 1920, the average US home cost $5,000. Today, the average US home is $500,000. But in 1920, if you had 20 or 250 ounces of gold, these little things you held in your hand, 250 of those in a shoebox, you could take that shoebox and you could buy a $5,000 house. In 2024, you could take that same shoebox of those little coins, those 250 ounces, and buy a $500,000 house. Same coins, still get a house. But if you had only had a shoebox of $5,000 in cash from 1920, it wouldn't even pay for the driveway or the landscaping in an American house. In other words, the gold, as they famously say, which does nothing but stare back at you. No, the gold is very, very, very busy doing nothing but retain its value as a store of value. That is not sexy. It's not as sexy as NVIDIA or Lucent or Qualcomm in the 90s when I was trading stocks, or all the ways you can get into, or even Bitcoin. It's not as sexy. It's boring. It does nothing but retain its value. Meanwhile, that shoebox of dollars is extremely busy, being traded all over the world. But what's it busy doing? Losing its value every single day. It's death by 1,000 cuts. It's so simple, stupid.
Despite the complex interplay of global economic factors, Matthew Piepenburg's analysis highlights the diverse forces fueling the rise in gold prices. He emphasizes the diminishing significance of the US dollar in international trade and the growing preference among central banks for gold as a safeguard against mounting US debt levels. According to the Congressional Budget Office, the US budget deficit widened to $1.7 trillion in fiscal year 2023 and will reach $2.6 trillion by 2034. Furthermore, US government debt held by the public is on pace to get a record 106% of gross domestic product in 2028, up from 97% in fiscal year 2023. It has soared to $27 trillion from $17 trillion in early 2020 and $5 trillion in 2007. This confluence of factors accentuates the importance of alternative assets like gold in safeguarding against the risks posed by deteriorating fiscal health and currency depreciation. However, Matthew succinctly warns against complacency regarding America's economic state, highlighting the historical inevitability of inflation and currency devaluation in debt-laden nations. He further emphasizes the necessity for fiscal responsibility, comparing America's financial situation to Banana Republic's balance sheet. Let's get back to the interview.
30,000 feet, the most obvious answer to why is gold going up, and Egon and all our team would agree, is it's not that gold is going up in dollar price terms, it's the US dollar is just getting weaker. That's the most generic. And then that really involves a history of currency debasement, which is throughout history and without exception, as I've said many times, when a nation, whether it's a monarchy, an oligarchy, a democracy, an empire, when it gets too over its skis in debt, inevitably, whether it's a Roman coin or a US greenback, it ultimately has to, or in the Deutsche Mark and the Weimar periods, those are extreme examples, but they eventually have to debase their currency to monetize their debts. So there's a currency and an historical issue. There are very specific reasons the US dollar is demonstrably going to be weaker when you print trillions of dollars, or I say mouse click them at the Federal Reserve. That does have a debasement inflationary consequence throughout our history. When we obviously dethroned ourselves, when we decoupled from the US dollar in 71, that had an immediate impact on the dollar's strength over time. They tried to correct that by having a petrodollar in 73 and then a COMEX in 74 to manipulate the gold price and manipulate the dollar's synthetic demand through the oil markets. So those are important forces too. But even the COMEX has less and less physical reserves now to use as a permanent boot to the neck or a permanent short on precious metal pricing. The other big theme is no longer just a headline taboo. It's happening in real time all around us since we weaponized the US dollar. For whatever your views are on the war against Russia and the sanctions against Russia, it has forced friends and allies in neutral countries alike to rethink trusting the US dollar and the US Treasury, because that was a dramatic thing to do to weaponize what is supposed to be a neutral reserve currency. So the de-dollarization story isn't just an exaggeration. The number of BRICS countries that are increasing in membership, including the United Arab Emirates, including Saudi Arabia, with have oil issues, have massive implications there. But also, it's not that they're going to necessarily have a BRICS-backed gold currency or for the BRICS, but they are net settling their trades in gold more and more. That's an obvious trend. The number of countries now settling or trade settling outside of the US dollar is extraordinary. In the oil markets too, again, the petrodollar since the 70s, which was very important to Kissinger and Nixon and Volcker, that we had this permanent demand for the US dollar. I've said many times it won't happen overnight, but there is a change in the US dollar's role in the oil markets. Unnatural demand, that forced demand for the dollar is changing. Last year, 20% of all global oil sales were outside of the US dollar. So now that would have been unthinkable in 2019 to say something like that. So that demand for the dollar is getting weaker, not overnight, but slow. And so all of these forces, what's happening in the COMEX, what's happening in the oil markets, what's happening with the weaponization of what was supposed to be a neutral reserve currency, what's happening with debt levels and the inability to pay them. And I think one of the more interesting things that's really on the table and is open to more people more and more is since 2014, central banks in the East in particular, but in the world in general, are dumping US treasuries and they're buying physical gold. And it's not just because of, has nothing to do with the Ukraine war or de-dollarization from the BRICS. That's because of the extraordinary debt levels in the US. There's less and less trust for that dollar, and there's less and less trust for that IOU from Uncle Sam. All of these forces converge on the gold price. But again, I'll end where I started. It really, the 30,000-foot answer is throughout history, all fiat money gets weaker and weaker. All broke nations debase their currencies. And as Hemingway and von Mises and others said, it's usually inflation and war when a country's in debt. You see these cycles. The inflation and the currency debasement, there is simply no exception throughout history, no matter how far back you go. When a country is too far in debt, when it crosses the Rubicon of unsustainable debt, like the US has, and it's a great country, I'm an American, we're both understanding the qualities of America, but we're not exempt from the laws of math and history. And nothing is written in the newspaper that's owned by corporations, or nothing said by a politician that's bribed by lobbyists or trying to toe the line can change the fact that America is a banana republic balance sheet.
If we consider purchasing power, currency devaluation, debt, control, and privacy in today's market environment, the case for owning gold in physical form is more important than ever. FBS, a leading global broker that has recently launched an upgraded FBS app, projects gold price surge to $2,800 per ounce by the close of 2024. FBS analysts foresee an upward trend for gold in the second quarter and until the end of the year. In light of these observations, how do you perceive the role of gold in your investment strategy, particularly in hedging against currency devaluation and fiscal uncertainty? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.